Well, good morning, Joginder Rana here. So, the product of the day is pay as you go insurance for motor vehicles. Pay as you go insurance for motor vehicles. See, pay as you go insurance for motor vehicles has become a boon for Indian consumers because the people who are working from home, they are taking advantage of it. If it's a model of coverage where you need to pay for only the time it is used, like your water or electricity bills. So the most common example of pay you go insurance is travel insurance. You take pay as you go travel insurance only when you take a flight and not while you are on the ground. So similarly, you may take overseas health cover when you are traveling abroad because you perceive the risk of losing bags or falling sick while traveling is high and worried that the expenses of healthcare or missed flights in a foreign land are too painful. This means the probability of an adverse factor occurring as well as the intensity of pain of such adverse events is perceived to be high, which drives your decision to buy travel insurance. Now, please appreciate both probability and intensity of pain are the key things that drive the need for insurance from a customer perspective. Where both these factors are high, the cost of insurance goes up, and where it is less, premiums are lower. So, in a long journey of life, people meet with many adverse events. They do not know when and how exactly they could fall victim to such events. Insurance companies can cover these uncertain adverse events and still make some money only when things are less probable so that they don't end up paying more than what their claim reserves could withstand. So if the probability is high, that means there will be a greater number of people who claim than what is estimated, and insurers end up and use losses unless they rate up their premium steeply. So this is the reason why high probable risk, that is home insurance for people living in riverbed, health insurance for people with critical illnesses are routinely denied because they are sure ways for the insurance companies to go belly up. So in pay as you go insurance, customers intuitively choose a high probable moments to pay for insurance, and they will avoid paying when the moment passes. This means pay you go insurance by design, the underlying risk are higher in the pool of policies the insurance companies covers. So naturally, insurers have to charge higher premiums for those short periods of high risk moments. Is this a boon for customer? Yes or no? Yes, because even if this short period pay you go insurance costs are proportionately high, still overall the customer saves money than covering the full year where only few moments could be high risk. So the example of travel insurance underscores this point. Why will anyone should take an annual travel insurance cover when he or she is likely to take only one or two trips abroad in a year? It makes sense only to cover those trips than the whole year. So if this logic is applied to car insurance or to the motor vehicle insurance, you pay for insurance only when you take the car on the roads, but not while it is in parking lot. It is in the parking lot. So just like toll, you pay car insurance too for the rides you go on expressways, where the probability of accidents may be higher. So it's a boon for the customer, right? While this could also cause some problems for the customers, imagine he or she forgets to activate the car insurance before going on a road trip. So insurance may not be at the top of your mind when you plan to go on a long drive with the family. So forgetfulness and too much selection in choosing when to activate pay-you-go insurance can negate the feeling of overall security a person should enjoy for a hassle-free life. So in essence, use pay-you-go insurance rationally. Do not expect to save a few rupees second guessing when you need it the most. The journey of the life is too unpredictable for average customers to don the hat of actuaries. Like in stock markets, the best advice is to stay invested and not try to time the market. In insurance too, staying insured for longer period may not be a bad idea. May not be a bad idea. So basically, this insurance companies are leaving no stone unturned in renovating its products and bringing a new wave of tech-based transformation as per the evolving requirement of users. So the car owners have the option of choosing their own insurance plan based on their car's uses. In fact, if you drive occasionally and drive well when you do, then you can save money big time on car insurance premiums. So pay as you drive or pay as you go in car insurance is one such example of an innovative and tech-based user-friendly coverage which has been launched under the guidance of the Insurance Regulatory and Development Authority of India, allowing users to pay exactly for what they consumed. So pay as you drive is a kind of non-conventional and new age affordable car insurance where the premium is comparatively low as it is paid on the basis of how many kilometers the insured has driven his or her car. This means the insured pays the premium for the distance he has driven their car. As in India, having a car insurance is mandatory, but it is quite a waste of money when you have to pay full premium on less used cars or if you only drive occasionally. So this thus pay as you drive or pay you drive comes into the picture, which is an ideal choice for those who do not drive very regularly. So for instance, any car insured who drives less than an average up to 2,500 kilometers in a policy year gets a whopping 25% discount on premium calculated on the basis of the annual kilometers left and odometer reading. So pay as you drive or PAYD car insurance is just like a comprehensive car insurance policy which has both the component of own damage policy and third party insurance policy. So the only difference is pay as you drive car policy uses smart technology and keeps a tab on driving habits of the insured and then charges premium which is comparatively very low as compared to fully fledged comprehensive insurance policy. And the premium payable under the PAYD policy is derived on the basis of how many kilometers the insured drives their car. So the working of the tech-based pay as you drive is quite different from regular and standard car insurance policy as it ensures more practical practice for car insurance policies. So while buying the OD policy, the policyholder is required to declare the usage of the car, usage based on the usage slip provided by the insurer, based on the car's usage and kilometers covered by the car in the policy period. The insurance premium or the insurance company provide the discount on the OD premium amount, which maximum goes up to 25%. So the PAYD plans usually have different slabs such as 2,000 kilometers per year, 5,000 kilometers per year, 7,500 kilometers per year, 10,000 kilometers per year, and so on. So this kind of cover, the premium is calculated based on the total distance driven during a policy year. There are slabs of distance which you can choose as per your uses. For example, car usage slab is 0 to 2,500 km. Discount on OD premium is 25%. Next slab is 2,500 1 to 5,000 km. Discount on OD premium 17.5% discount. 5,001 to 7,500 kilometers. Discount on on OD premium is 10%. 7,500 kilometers to 10,000 kilometers, discount on premium is 5%. And more than 10,000 kilometers, there is no discount. So to gauge and check upon the usage of kilometers driven, the insurance companies install a tracking device based on smart technology, such as telematics, onboard diagnostic sensors, self-installed device such as pen drive, advanced or high-tech GPS device, or with the help of a mobile app. So along with the car's usage and mileage, these tech-fitted devices help a lot in accurately measuring the other dimensions of car driving, such as acceleration, braking, speed, location you drive. So how often and for how long your whole driving pattern is linked either to an app or your mobile phone or on some sort of device. There are several rewards also which many insurance providers offer to promote safe driving. However, if your declared car usage limits gets adjusted, then you have an opinion or option to enhance or top up the kilometers usage or shift to regular OD car insurance policy. Insurance companies such as HDFC Ergo, Eco, Digital, Reliance General, ICICI Lombard, such companies provide pay-as-you-drive or pay-as-you-go car insurance policies. So PAYD also allows another version where the policy follows switch on and switch off more motor insurance. So you can turn on your own damage cover while you are driving and switch it off whenever you are not using your car. One more variation of the usage-based policy is switch insurance policy, where you can switch on your own damage cover when you are driving and switch it off when you are not. This simply works on the principles of the direct usage of cars on an everyday basis, where switching on and off can be done via mobile app. So at present, there are few insurance players such as Kotak General and Juno General, which are having three kinds of policies. The best part is that the companies give extra reward if the car is switched off for a whole day. Moreover, the policy holders of such policy can earn up to 40% cashback for unused days of the car and can also request for a discount on renewal premiums. So the insurance companies gauge the switch on off mode via mobile app, which has to be downloaded by the insured at the time of purchasing the policy. So what are the key features of pay-as-you-drive or pay-as-you-go insurance? Tenure of the PAYD policy is generally 1 year. Premium is entirely dependent on the usage slabs of the kilometers covered. While the maximum discount is of up to 25% on their own damage insurance premium. Flexibility to announce the car insurance cover by opting for add-on covers, and it provides coverage for own damage and third-party liabilities. Now it is obvious by now that pay-as-you-drive is a smart way of saving yourself from hefty premiums which have been charged on car insurance. So by pay-as-you-drive, you are actually paying till your driving limit, which generally suits to the best. If you do not drive that often but still shell out the same premium as a driver with heavy uses, or aged or a senior citizen and drive less often, you are a college student and still clearing your hand-on driving, you have multiple cars at home and use one car more than the other, you rent a car and require insurance for a short period, you live in remote areas or work from home and drive very less, you reside in a small city where car usage is generally less than 10,000 kilometers per year. So pay-as-you-drive is a better option than a regular or standard car insurance policy, totally depends upon the individual's car uses, where they live and how many cars they drive. So if you are a college student who really doesn't indulge much in driving, then pay as you drive is an affordable option for you. Similarly, if you drive occasionally, then also pay as you drive is ideal for you. It also depends if you live in remote or less crowded areas. Then pay as you drive will benefit you as it charges less for less mileage driven on emptier roads rather than the crowded spaces. Let's see the benefits of pay as you drive. Promotes better driving habits on roads as the data recorded in the devices helps you to adopt safety measures while driving. Offers discount up to 25% on own damage premiums as per the kilometers driven during the policy year. Thus, pay as you drive is a cheaper option as compared to regular car insurance policies. There are no charges for the installation of telematics or any such devices. The telematics device is installed work as an anti-theft device as it comes along with a GPS tracking board. So insurance companies don't charge extra even if they drive for more kilometers than declared. You can easily top up or enhance the limit at no charges. Companies provide additional discounts up to 5% in case of claim-free year, which encourages responsible driving. So pay-as-you-drive coverage is quite flexible as it allows you to cover your car based on your uses. Pay-as-you-drive is a new offering in the insurance market, which a lot of general insurance companies have started offering to woo their customers. So you can buy this as an add-on cover very easily by visiting the official websites of the insurance company. As soon as you log in and buy pay as you drive or pay as you go cover, the insurance company might ask you for the personal and car details. So after this step, the insurance company will install or fit the smart technology devices in your car at no extra cost, which will attack the total distance covered by your car. So declare the car usage and all the other potential or pertinent information to your insurance provider and select a car insurance policy accordingly. Make the payment online and download the car insurance policies along with pay as you drive cover, which is received in your inbox. What is covered and not covered in pay as you drive insurance is important, because in the covered category you will find that the damage to the car due to accident or collision are covered, damage to the car due to theft or vandalism is covered, damage due to man-made or natural disasters covered, damage due to fire or explosion covered, third-party liabilities are covered. But then what is not covered? Driving without a valid license, driving under the influence of drugs or toxic substances, general or regular depreciations, damage due to electrical or mechanical issues. Means whatever is the coverage of the policy and what are the exclusions of the policy, they are similarly applicable. So pay as you drive is offered on the basis of car usage. The plan is very much similar to a comprehensive insurance policy, which include the main two components such as third-party premium and non-damage cover. It is to be noted that though it is offered as a comprehensive cover, it is considered to be quite a cheaper option as compared to regular and traditional comprehensive policy. However, it allows full flexibility of adding add-on riders such as zero depreciation, engine protection, emergency roadside assistance, no claim bonus protection, and return to invoice cover, and so on. So all the general insurance companies are providing it, and this is available with most of the companies now. Thank you very much.